Okay, welcome everyone for the third session of the conference. We have a couple of very interesting papers to be presented. First one is Jasmine Xiao from University of Amsterdam. The floor is yours. You have 30 minutes.
Where are the slides?
The slides are missing from here. If someone could put them.
Oh, no. Yes. Okay. Okay. Hello, everyone. Thank you for including the paper on the program. This is joint work with Christian Baumeister and Fiorella de Fiore. The title of the paper is When the Unthinkable Happens, Perceptions of Monetary Policy in Tail Events. The usual disclaimer applies. So what do we do in this paper? There is ample of evidence that the public has imperfect information about how the policymakers respond to shocks. In other words, imperfect information about the policy rule. And the imperfect information problem is particularly acute during challenging times when tail events occur, such as the 2008 financial crisis, 2020 pandemic, or the recent war. In addition, there is limited evidence on the relevance of public perceptions for policy effectiveness and macroeconomic outcomes. So in this question, we asked two questions. First, how do public perceptions of monetary policy evolve after a tail event? And second, can they amplify and propagate shocks through belief-driven dynamics? In other words, what's the macro implications of evolving public perceptions? So to answer these questions, we do two things. First, we propose a new Keynesian model with two special features. One, we feature non-normal shocks in order to capture tail events. And second, we have imperfect information. Or to be more precise, we have asymmetric information between the public and the central bank. So we use this model to discover a new mechanism in the face of a large negative supply shock. So in the calibration, we use an oil supply shock as in the 2020, but the model is more general than that and doesn't have to be an oil supply shock. And in the model, the public learns endogenously and simultaneously the supply shock distribution as well as the policy rule. So there is a two-layer learning problem. And in the second part of the paper, we test the model mechanism in the data using US data and a nonlinear VARX model. So what do we find? We have three key findings. First of all, we show that in the face of a large negative supply shock, such as the one in 2020, the public tends to underestimate the central bank's response to inflation. And secondly, such misperception tends to generate inflation persistence as well as sustained output gap overshooting. And thirdly, we show that stagflation, such as the one in the early 1980s, can arise in the model when the public has limited confidence in the central bank's commitment to price stability. In other words, the model can simultaneously explain why there was no stagflation after 2020 and why there was stagflation in the 1980s. Okay. So the first part of the paper is a new Keynesian model with imperfect information. We start off with the linearized three-equation new Keynesian model, but we are in the process of extending this to the nonlinear framework. The first equation is the standard Phillips curve. We have VT, which is the supply shock. So a negative supply shock increases inflation here. And the second equation is the Euler equation, the standard Euler equation. And the third equation is the monetary policy rule. So we highlight in pink here everything that is not observed. So VT, the supply shock, we say that it's IID and follows a generic distribution G So this doesn't have to be normal to take into account that this could be a tail event. The monetary policy shock epsilon is IID normal, but is unobserved. Psi t, which is the shock to phi pi t, is also IID normal. All of these are uncorrelated. So phi pi t is an AR1 process that is not observed by the public. So the public does not observe Vt, phi pi t, or epsilon t in the model. So all agents are fully rational, but have asymmetric information. Private sector does not observe any shock, nor the distribution of the shock G, nor phi pi t, and only the central bank knows phi pi t and epsilon t. In other words, only the central bank knows the policy rule, but not the private sector. And agents are endowed with the belief G hat t minus 1, phi pi hat t minus 1 at the beginning of a period t, and they learn endogenously from the macro outcomes, pi t, xt, and it, in order to update their perceptions. So we use a hat to denote the perceptions. So just to be precise here, so they learn about the supply shock distribution, the monetary policy rule, and the monetary policy shock endogenously and simultaneously from the macro realized outcomes. Okay, so that is the model, and it's important to clarify the timing to see how the model is solved. So at the beginning of period t, agents are endowed with the belief phi pi hat t minus 1 and g hat t minus 1. So remember, G is the perceived distribution of the supply shock. So this is the anticipated utility approach in these learning models. So they use these beliefs to form expectations, the expected output and expected inflation and expected output gap. And because the agents do not observe the actual policy rule, so they have a perceived policy rule, which looks very much like the actual rule, except instead of phi pi t, we have the phi pi hat t minus 1. And then in the middle of the period, all shocks are realized, but they are not observed by the agents. The central bank sets IT according to the true policy rule, and macro outcomes pi t, xt are realized. So in equilibrium, inflation and output gap are functions of phi pi hat t minus 1, Vt, the supply shock, epsilon hat t, the perceived monetary policy shock, and g hat t minus 1, the perceived shock distribution. So here I'm highlighting Ft because since the perceived shock distribution varies period by period, so the policy functions are also time varying. And in addition, we have the monetary policy rule, the actual rule, and the perceived monetary policy shock, epsilon hat t, has to ensure that the actual rule, the interest rate under the actual rule is equal to the interest rate under the perceived rule. And then at the end of the period, when all outcomes have realized, the private sector, they update their belief. So first, from phi pi hat t minus 1 to phi pi hat t, given the realized macro outcomes. And they also have a perceived supply shock given the macro outcomes. So they back these out using a particle filtering algorithm. And then they also update the perceived distribution of the shock, G hat t, using the sequence of perceived supply shocks using kernel density estimation. So why do we have these two algorithms? So the model is nonlinear because of the interaction of phi pi t and pi t, and we have a potentially non-normal shock, Vt. And therefore, we use a particle filtering algorithm to take this nonlinearity and non-normality into account. Okay, so now let's look at the results. As I mentioned at the beginning, we use oil supply shock as a proxy for the VT, but the story is not necessarily about, about the oil market. So it could be about any supply shock. So we use the Baumeister-Hamilton 2019 oil supply shock series. That's the data on the left panel. So there was a tail event in 2020 Q2. And on the right-hand side, what we have here is if we plug in these oil supply shocks, if we plug into the model the oil supply shocks and we estimate the perceived distribution given the endogenous outcomes, what does the perceived distribution look like in each period, at each point in time? So the green line is the perceived distribution using the history of perceived shocks up to 2020 Q1, so before the tail event happens. And when the tail event happens in 2020 Q2, we see a slight shift to the left. So under learning, a tail event after a long period of small shock lies outside the perceived distribution. In other words, when the shock happens, agents do not have that extreme outcome in their perceived distribution, which is the green line. But then they update after that, and we see that the change in the perceived shock distribution is fairly persistent because the tail remains even in 2024 Q4. And now I replace the left-hand chart by the actual distribution, which we compute by just using kernel density estimation on the series of actual shocks. So the key takeaway here is that the left tail in the actual distribution is longer than under the perceived distribution. So what's the implication? The implication is the revised perceived distribution builds a slightly longer tail, but is still shorter than the actual tail. In other words, the tail event remains unthinkable even after it's happened. So now the question is, why is the tail still shorter under the perceived distribution? Okay, so perhaps that's going to be clearer in this exercise. So here we plot the impulse response functions under a large negative supply shock in the model. So we have three state variables. We have VT, which is the supply shock. We have policy responsiveness, which is phi pi t, and we have the actual policy shock, epsilon t. So that's the top panel. These are the actual shocks. And the lower panel shows the perceptions of the agents. So the focus here is this one, the perceived policy response, phi pi hat t. So what this is saying is that when the large negative supply shock happens, we have an underperception of phi pi hat. So the actual policy responsiveness is kept at 1.5, but agents perceive it to be much lower. So why is that? So in the model, agents simultaneously learn phi pi t as well as the shock distribution. They observe high inflation, but because at the time that the shock happens, they do not know the possibility of this left tail. So they think the largest supply shock is somewhere here. As a result, they think that part of the increase in inflation must be due to a lower perception of lower policy responsiveness to inflation. So that's why they rationally misperceive the central bank to be less hawkish in order to explain the high inflation that they see after the large supply shock. And that is precisely why the perceived distribution, the left tail, is smaller than the left tail of the actual distribution, because the increase in inflation is partly attributed to a reduction in the phi pi hat. So that's the first key result of our model, that agents misperceive the central bank to be less hawkish in the face of a large negative supply shock. The second result, so what's the macro implication of such misperception? So in the top panel, we plot inflation, output gap, and interest rate. We have persistence in inflation, and we also have output gap overshooting. So the baseline where they simultaneously learn about phi pi t and gt is the dark blue one. So to dissect the mechanism further, we conduct 3 other counterfactuals. The green one, which you can hardly see, is the full information. So under full information, because the shock is IID, is one period, so once the shock is over, inflation and output gap goes back to 0. And the second counterfactual is where they only learn about phi pi t, so Vt and G are known to the agents. We see that there is virtually no difference between this case and the full information case. In other words, simply learning about phi pi t is not enough to generate the persistence and overshooting that we see here. And the third counterfactual is, suppose that the agents, they know phi pi t, but they have to learn about the distribution. So here, they learn about distribution endogenously by observing pi t, xt, and it, and that is the light blue line. So here, what that's missing compared to our baseline is the output gap overshooting. So we have the stagflation scenario. That is because this demand boost channel is absent, and everything, the stagflation comes from the shift in the distribution of the supply shock, or the perceived distribution of the supply shock. So the output gap overshooting really distinguishes the 2 mechanisms or the 2 models here. And the output gap, why does this happen and why does the persistence happen? So for persistence, there are 2 reasons. One is the persistent shift in the distribution of the supply shock. That leads to inflation persistence. Also, persistent decline in the output gap. And the output gap overshooting really comes from this demand boost channel. So the reduction in the perceived policy response phi pi hat. And the only persistent variable in the model is phi pi t, which is AR1. So all the actions of the expected variables, once the shock is over, comes from the evolution of phi pi hat once the shock is over. So we have expected output gap persistently above target even after the shock is over. So the key takeaway here, I know this is a lot of lines in one figure, but the key takeaway is that the misperception is reinforced by inflation persistence and output gap overshooting. Okay, so what about the stagflation in the 1980s? So here we conduct a comparative statics experiment. So suppose that before the tail event happens, agents prior of the mean phi pi is mu instead of phi pi bar. Phi pi bar is 1.5. So suppose that the central bank has, suppose that the public has little confidence in the central bank's promise to stabilize inflation. That's the intuition here. So we see that the perceived policy response drops even more. However, there is no more output gap overshooting. In other words, we are back in the scenario of stagflation in the 1980s with high and persistent inflation and low output gap after a supply shock. So that's the key distinction from the baseline model. And finally, we conduct another exercise where we try to understand the nonlinear impact of tail events. So a small shock here is 1 standard deviation shock, and a large shock is a 4 standard deviation shock, which mimics the shock we see in the Baumeister-Hamilton series in 2020 Q2. And to make the impulse responses comparable, we scale both sets of impulse responses such that they generate the same increase in inflation upon impact of the shock. However, we see that with small shock, the amplification mechanism really disappears, so we have very low persistence in inflation and no output gap overshooting. Therefore, we conclude that the tail event generates qualitatively different dynamics from just a small shock, and the amplification mechanism is highly nonlinear. And we take these predictions to the data using a nonlinear VARX model. So this is the model, this is the empirical model. We use, again, the Baumeister-Hamilton oil supply shock series. That's the UT oil series. So in order to understand the nonlinear impact of a tail event, we include a nonlinear term here, which is the function f. So the f, to make it transparent, for now we just use a quadratic term to capture any disproportional effect of a tail event. So for instance, for a small shock of 1 standard deviation, the effect is approximately alpha plus beta. However, for a large shock of, say, 6 standard deviation, the effect would be 6 plus 36 beta. So in the VAR model, we have 8 endogenous variables besides the exogenous variable, the oil supply shock series. In particular, in order to tie in closely with the New Keynesian model, we include the perceived policy response to inflation taken from the estimates by Bauer, Pfluger, and Sudaram. In addition, we also include summary statistics of the oil supply shock distribution. We have 2 moments. One is the mean, and the other one is an asymmetry measure, which is the distance of 5% and 95% quantiles from the median. But we also have robustness check where we use the skewness. So the sample period for the empirical model is from 1985 to 2019. So it doesn't actually include the COVID 2020 Q2 shock. So why is that? 2 reasons. One is that if you do a lot of empirical work with these models, you would know that the COVID period really messes up a lot of the things in the data. But more importantly, we actually use this as a out-of-sample test for the model mechanism. So the fact that we are going to see in the data what we saw in the model is further enhances the validity of the model mechanism. So this is these are the impulse response functions to an oil supply shock that induces a 10% increase in oil price. So we have small shock and big shock, and to make the comparison valid, we scale all impulse response functions such that both the small and the large shocks induce a 10% increase in oil price. So we have oil price output gap. We see after a temporary dip, there is very persistent and very large output gap overshooting. We have inflation persistently above target. This is a federal funds rate with a shadow rate. And we have inflation expectations, which is persistently high. And this one would be the phi pi hat in our model, so the perceived inflation response. We see that it goes down after a tail event. And these, the last two, are the summary statistics of the shock distribution. Basically, these show that the shock distribution has shifted to the left after a tail event. So the key takeaway here is that these results validate the model predictions for both macro outcomes and belief dynamics. And again, the tail event generates qualitatively different dynamics from just a small shock. And I will leave the last slide here for you to read. Thank you.
Thanks a lot, Jasmine. So Laura, go ahead with your discussion.
So thank you very much for asking me to discuss this really cool paper. So I'm going to go ahead and summarize the paper in just one slide using this very simplified representation. So imagine that the true evolution of inflation is just this simple equation where inflation depends on itself with some parameter, phi pi. This is obviously substituting in some sort of policy response rule, like a Taylor rule, where phi pi is the Taylor coefficient in the Taylor rule, so the responsiveness of monetary policy to inflation, and some cost per shock Vt with some parameter B, which is positive. But instead of this simple law of motion for inflation, the agents in the model perceive that inflation depends on the true monetary policy rule, but with a potentially time-varying response coefficient. That's this phi hat. And there is some perceived shock, cost per shock, that comes out of agents' perception of what the distribution of the shock is. Okay? So basically, this means that agents observe, or agents have one signal, which is realized inflation, and they use that one signal to learn about two objects. One is the response coefficient, and the other is the cost per shock, including its distribution. And so basically, the mechanism that happens in this model is that when there is a cost per shock, so here in this simple representation, Vt goes up, then through the actual evolution equation for inflation, that drives inflation up. Then agents see inflation going up, and then because they have no more information in the data, they distribute that information evenly across the two things that they think is thinkable that these might be moving. Okay? So that leads them to underestimate the change in Vt, but overestimate the change in the inflation response coefficients, which was actually 0, but now they are thinking that it moved. Okay? And that's what generates the mechanism in the model that, if you extend the model to the full specification that Jasmine showed us, where there are expectations in the inflation equation and there's an output gap equation separately, that leads to persistence because the expectations inherit these misperceptions. And on the other hand, because the inflation response coefficient is underestimated, that makes agents think that monetary policy is more expansionary than what it is. So you get this output gap overshooting. Okay, so that's the model in a nutshell. And so that leads me to my comments also on one slide. So this mechanism really hinges on the configuration of what is thinkable or unthinkable, both for agents in the model and for the model itself. In particular, what I mean is that the misperception about the Taylor rule coefficient on inflation is very important because since agents are using observed data to learn about the things that they think may be moving, that's where the misperception of the inflation coefficient arises. Okay? And that's why it's really important that agents think that the fact that the distribution of the cost per shock may be changing is a little bit less thinkable than the fact that the Taylor rule coefficient may have changed. Okay, so this misperception of phi pi is really important. And so the big question that arises is, what if agents were informationally on the same page regarding all the parameters of the model? So in particular, what if the agents also had similar information about the response coefficient to the output gap in the Taylor rule, or the other parameters of the model? So I think that ideally what one wants, and I think that the dynamics that the model produces would obviously survive in these cases, but I think that what one wants is to check and make sure that it's not the particular configuration of what is thought to be unthinkable by the agents and what is considered very thinkable, such as a changing policy parameter, when it's actually, from the model perspective, unthinkable, since the Taylor rule is actually constant. Which leads me to my second point, which is, what if the thing that was unthinkable from the perspective of the model was actually thinkable, which Matthias will agree, that there's a time-varying Taylor rule coefficient? What would that do to model mechanisms? So in that sense, if agents are actually not wrong in thinking that a changing Taylor rule coefficient is thinkable. Okay, I think I've exhausted how many times I can say unthinkable, unthinkable. But basically the high-level point is that the very precise configuration of what agents believe can happen or not may be thought to drive the results, and I think it would be important to show in some general and symmetric exercises that this is not the case. And I think that's not going to be a hard thing to do. And then obviously, from a policy perspective, the big question that arises is, what can policy do to help agents unlearn a misperception? Because here, basically, the story is that you got really unlucky, there was a big shock, and now on top of everything, agents are also thinking that you don't care about inflation. And so as a policymaker, do I want to really double down on inflation? So do I really want to move the interest rate? At the same time, if agents are convinced that I'm very dovish, then it's hard. So what scope is there for policy action to improve things here? So that really concludes my discussion, and then we'll discuss about more technical points offline. Thank you very much.
Thanks, Laura. Okay, we can take a few questions.
Do I go back up?
You can answer here. Sorry, you could also answer Laura's first. Yeah, please go ahead and answer Laura first.
Yeah, so thank you very much, Laura, for both what's on the slides and what we're going to discuss later. Yeah, so these are all excellent points. So we can definitely do a symmetric case of learning about phi x instead of phi pi. I think having two particles in the algorithm may not be manageable for now, but one at a time is definitely manageable. And so we have an exercise, which we have tried an exercise of impulse response functions when phi pi changes, as well as a supply shock. So in that case, basically the misperception here, or the learning mechanism here, weakens, say, an actual increase in phi pi in the policy rule. So, but we have not explored, say, optimal policy in the paper yet. So that's definitely scope for future work. Thank you again. Yes.
Okay, thanks. Now we can go for questions.
Okay, so two two questions. Can you comment on learning about the distribution versus learning about the variance? Learning the variance may be more tractable, but it may give you, is it really crucial for your results that agents are learning about the entire distribution? I know you want to emphasize this point about tail events and so on. But maybe learning about the variance would be sufficient for some of the results. And then the second point, it's about the initial conditions for these simulations that you show. So what is it exactly, what's the environment at time zero at the beginning of these simulations? Is it that the true distribution is always constant? And is it that constant over time? And is it that by time zero, agents have converged to some steady state of their learning? Or is it that they're off their steady state at time zero?
Okay, please pass on.
Also two questions also to understand better. One is, I don't think you showed it, but it would be interesting to see how volatile the phi pi, estimated phi pi is in your simulation to match the data. I mean, as you showed, we have evidence of time variation in this phi pi, but it is also bounded. So it would be interesting to see that your results are not hugely volatile. And the other one, I guess, is related to what Bartosz said also. So how important is it to have this general distribution for the V shocks, and vis-a-vis something more, normal, or maybe just normal with time varying variances, something. So how important again is the non-normality? And finally, there is the central bank here. In principle, could also, I mean, it doesn't need to in your model, but it could, in principle, also run, a filtering of. Well, I guess the only thing that the central bank doesn't see is the markup shock. I don't know whether it's a trivial problem, but in any case, there could be some scope for the central bank to communicate to the private sector also, maybe in a noisy way, its views, and it would be interesting to know how much that would have an impact on the equilibrium.
I was wondering how well the VARX model fits to your DSG model, in the following sense: as far as I understand, shocks in your model change the perception about systematic monetary policy. That will change the propagation of any other macroeconomic shock happening later. I mean, to the extent that that is persistent. So I'm struggling a bit to understand how you can put that into a VAR model in which the only nonlinearity is put on one shock and not on all the shocks. Thanks.
Could you pass here?
Well, thanks for the presentation. I have two related questions. Your mechanism seems related more broadly to the fact that people misinterpret a supply shock with a change in monetary policy that could be viewed also as a generic demand shock. So would your mechanism hold also if, in this case, that if it is not a change in the Taylor rule, but rather that people don't understand that whenever there is an increase in inflation due to a tail supply shock, they misinterpret it as an expansionary demand shock. And second is related to this misinterpretation of supply versus demand. I think it's crucial to clarify what people can observe. Because if they can observe simultaneously inflation and output, they would hardly confound the supply with demand mechanisms. So,
Francesco Modeo, UC San Diego. I have a very similar question because I'm wondering, in particular for a situation of tail scenarios, it might be relevant also to discuss the potential unobservability of fundamentals like inflation. You have a filtering approach, which means people observe inflation and they learn, as the discussant was highlighting, about two things contemporaneously. But in particular for tail events, maybe the observability or even the agreement on fundamentals like inflation and output gap is a relevant dimension to explore. And this opens up another question, which is about the non-linearity about the Taylor rule, because if both inflation and the coefficient on inflation are unobservable, then the particle filter cannot handle the filtering problem anymore. So I was just wondering if you have thoughts or if you have explored this dimension.
Okay, and then one more question here, Günther.
Yeah, Günther Köhn from the ECB. So I think this is a very nice framework to think about alternative sources of persistence, inflation persistence in response to supply side shocks. But whereas Bartosz asked for eventually simplifying, say, the setup by estimating the variance as opposed to the distribution, I would like to go one step further from a practical perspective nowadays. So it's basically also the question, how persistent is the shock in itself? And I would suppose, so for your model, that would be another very important source of uncertainty that could also endogenously contribute then to the persistence of the system, to the extent that even if the current shock is observed, so the uncertainty about the persistence of the shock in a forward-looking model should of course also then have an important impact on the behavior and the decisions taken by individuals in your setup. So, and I suppose this would make the estimation problem more difficult, but it could add a very interesting, also quantitative angle then to the implications, the predictions of your model. Thank you.
Okay, I think that was all the questions, so you can go ahead to answer them.
Yes, so there were more than 10 questions and I have less than 2 minutes. I will have to pick a few, but thank you very much for all the questions and the comments. Maybe we can talk during the discussion, during the break also. So I will try to do chronologically. So Bartosz, the first question, learning about the variance. The short answer is we haven't tried that, but my hunch is you would not get the mechanism that you see here, because here really what we emphasize is the left tail, but with a wider variance, the agents would also attribute some weight to the right tail, and it's not clear that's going to generate the misperception of phi pi. And we have an exercise where we say that the distribution is known and agents only learn about the phi pi. And in that case, the key results, the output gap overshooting and the inflation persistence, those disappear. So we really emphasize the joint learning of the whole distribution as well as phi pi. And the next question about the true distribution and the initial conditions, that is an excellent question. So in the impulse response functions, so before the shock happens, the distribution is the 2020 Q1 distribution. So we assume that agents have fairly accurate knowledge starting from the steady state, stochastic steady state, before the shock happens. And whether the true distribution is constant over time, the correct answer is no, it's not. So as the shock distribution changes, actually there is changes in the stochastic steady state. And that's exactly why we are now going fully nonlinear, in the process of going fully nonlinear, to take into account that stochastic effect. Yes. Okay. So unfortunately, I only managed to two, but can I just answer maybe one clarification, because I think that's important for the. Perhaps I didn't. I wasn't very clear in my talk. So agents, when they do the particle filtering, they do take into account the changes in both pi t and xt, well, as well as it. So I guess your question is why they seem to attribute more weight to the changes in inflation and than in the output gap. I think that's a quantitative question in the model, but yes. Okay, so the other questions, I will try to find you during the break to answer them. Yes, thank you.
Okay, thanks again.